Ever wondered what actually happens when you put your money in a bank? Or how banks make money even though they don't charge you just for keeping it there? Well, today we're going to break down how banks really work in a simple and clear way. Let's start with the basics. When you deposit money into your bank account, say $1,000, you're not just storing it in a vault like in the movies. You're actually lending it to the bank, in a way. That's right. Your bank account is like a small loan you're giving the bank. And what does the bank do with your money? They lend it out to someone who wants to buy a house, start a business, or maybe just get a car loan. The bank charges interest on that loan, maybe 6%. And in return, they might give you 1% interest on your savings. So if they're making 6% from the person borrowing the money, and they only give you 1%, that extra 5% becomes profit for the bank. That's one way they make money, but it doesn't stop there. Banks also make money from things like overdraft fees, credit card interest, late payment charges, and even small fees for services like wire transfers or ATM usage. They can also invest your deposits in financial markets or lend money to other institutions. But with all this money being moved around, isn't it risky? Yes, it is. That's why banks are heavily regulated. Governments and central banks, like the Federal Reserve in the US or the European Central Bank in Europe, oversee banks and make sure they're not taking on too much risk. One rule they enforce is something called a reserve requirement. This means banks are required to keep a certain percentage of their total deposits, often around 10%, in reserve. They can't lend it out. Why? Because if everyone decided to withdraw their money at once, the bank wouldn't have enough cash on hand. That situation is called a bank run, and it's very dangerous for the economy. This actually happened during the Great Depression and again during the 2008 financial crisis. To help prevent panic, some countries, like the US, have deposit insurance. That means even if your bank fails, your money is protected up to a certain limit. In the US, that limit is $250,000 per person, per bank. Now, aside from storing and lending money, banks also provide important services like credit and debit cards, mortgages, personal and business loans, currency exchange, online and mobile banking, payment processing. In many ways, banks are the backbone of the modern economy. They keep money flowing from people who save it to people who need it. But they're not perfect. Sometimes banks make risky decisions. Sometimes they prioritize profits over people. And when they fail, the impact can be huge, not just on customers, but on the whole financial system. That's why oversight, regulation, and smart banking practices matter so much. So next time you use your bank card, get a loan, or check your savings balance, remember, you're participating in a massive, interconnected system. A system that, when it works well, helps businesses grow, helps people buy homes, and keeps the economy running. And that's how banks work. If you enjoyed this breakdown, make sure to subscribe for more clear and simple finance explainers.